I think we are probably going to see that risk on continued in the next couple of weeks. There are really a few indications that keep us pretty constructive on risk assets. When we look, for example, at our top-down leading indicators, they're all ticking up, or at least looking a little less negative. Our earnings expectations, expectations from consensus, particularly for the near term, for the upcoming Q1 reporting season, they look incredibly bearish. It's very different further out, but for Q1 specifically, they've really been downgraded a lot. Our earnings indicators also are picking up. And I think importantly, you mentioned March was a pretty challenging month, of course. But when we look at sentiment and positioning has clearly become a lot more downbeat during the month of March. And that does provide some comfort really for us to keep being constructive on risk assets overall.
Max, we've already got movement for the quarter this time on the back of OPEC and its moves around output levels. This has moved the sector in oil, one of the underperformers for March. Banks, of course, the other underperformer. Where do you think both of those two various parts of the market now sit going into April?
Yeah, I mean, I must be honest, I didn't expect that one to open Q2. My hopes were perhaps for a slightly more quiet Q2, and particularly the beginning, but it does look like, we're racing into the next sort of event. But I do think particularly the banks here look really attractive, particularly in the US. Let's not forget that the larger banks in the US have underperformed by a significant margin against their European peers from September last year onwards, right? As we were playing the ECB catch-up trade and then sort of trading the story that the Eurozone will perhaps not fall into recession, avoid a recession overall. So US banks, I think some of the pessimism is a little bit overdone, is a little bit exaggerated. And with a stabilization there, with a stabilization also in interest rate volatility, I do think that really banks here look pretty good value. Now, when it comes to energy, I think on the energy side of things, of course, from an equity perspective, they are pretty attractive when it comes to income, right? High dividend yields and so on and so on. But what we've got to bear in mind is that an environment where actually leading indicators from a top-down perspective are picking up, that generally doesn't speak in favor of income investing. It speaks more in favor of cyclical exposure, right? So perhaps this is more the environment where you want to go into even more pro-cyclical sectors like materials, again, like the banks, right? And really play that sort of pro-cyclical uptick in the leading indicators.
Which is fascinating, Max, because, I mean, I just see confusion here in the data, in reality. And we've got a Saudi-led OPEC output cut that seems to be predicated around the idea that the global economy continues to slow and therefore demand continues to fall. But what you're saying seems to, turn the glass the other way around, and you're much more half glass full than half empty at this stage, it seems.
Yeah, I wouldn't even say half glass full. I'd probably say 3/4 full, because to be honest, when we look at our indicators, right, our top-down leading indicators, they all look a little bit better, right? Our earnings indicators look a little bit better, and frankly, what you just mentioned, the confusion overall among investors, that doesn't need to be a bad thing. It's actually a good thing, because imagine if everyone would already say, well, we know, near-term earnings expectations are really low, so that's going to be an upside surprise. We know that PMIs are definitely have seen the trough, so that's going to rise as well. If everyone agrees that things are actually taking up, I would be much less constructive. But the fact that what you just mentioned, the fact that we have this confusion, that really investors, particularly from a real money investor perspective, are really quite downbeat, both in high yield credit and in equities on our measure, still outright underweight in both of them. That still actually does keep us quite constructive, because it does line up the rather upbeat mood on the leading indicator side, both bottom up and top down, but also fairly downbeat sentiment and positioning. And that's usually a very conducive environment for further upside for risk assets.